Plug Power is trading at just $1.96 today, but a few weeks ago it was above $4.50, while analysts still hold a $7 target. That massive disconnect is the real story. Plug Power Inc., trading on the NASDAQ under the ticker PLUG, is currently priced at $1.98 per share, showing a small intraday move of roughly 0.01 or 0.51% as of late morning on November 26, 2025. On the surface, this seems like just another minor fluctuation, but beneath that tiny move is a moment of extraordinary significance for the company. In fact, Plug Power is standing in one of the most volatile, controversial, and existential phases in its entire history. And what's most compelling about the situation isn't even the movement in the stock price. It's the enormous disconnect between Wall Street's long-term confidence and the company's very real, very immediate need for capital. You may look at the stock today and see $1.98. But the real context is that only a few weeks ago, this same stock was trading above 4.50. At the exact same time, a well-known analyst firm maintained a $7 price target. That massive distance between what the stock is worth right now and what some of the pros expect it to be worth in the long run is the core tension that every investor in Plug Power is feeling today. And this situation is also one of the clearest examples of what happens when a company in a high-growth, capital-intensive industry tries to scale faster than its financial structure can support. Plug Power has long been marketed and viewed as a pure play on the future of green hydrogen. The company isn't just selling a single product, it's selling an entire ecosystem, from hydrogen production to hydrogen consumption. Its electrolyzers are designed to produce clean hydrogen fuel. Its fuel cells are built to power forklifts in massive warehouses, to run stationary power for critical infrastructure like data centers, and even to support future hydrogen-powered trucks. This vision has attracted investors who believe hydrogen will one day become a central pillar of the global energy transition. But the reality has been much harsher than the idea. Building something as complex as an entirely new energy infrastructure, especially one that competes with mature fossil fuel systems, takes massive amounts of money. Capital is the lifeblood, and Plug Power has needed a lot of it. The recent drop in stock price wasn't caused by a sudden operational collapse. Instead, it came from something far more basic but equally impactful: changes to the company's capital structure. Plug Power recently announced a large convertible senior notes offering. In simple terms, this is new debt that can one day convert into stock. They also proposed increasing the company's authorized share count to a staggering 3 billion shares. As expected, investors immediately reacted with fear of dilution, and that fear triggered a sharp and painful sell-off across the stock. To Plug Power's credit, the financing did secure around $400 million in net cash. This is substantial enough to pay down high-cost debt and help fund the company's current business operations. However, this move also reinforced something skeptics have said for years: that Plug Power's cash burn is the company's #1 challenge. And until that issue is solved, every positive headline, from electrolyzer deliveries to major partnerships, will continue to be overshadowed. When you look at recent trading activity, the stock has been a complete roller coaster. In mid-November, the stock slid sharply, dropping below $1.80 before attempting a slow, fragile recovery. Trading volume has been enormous, frequently surpassing 100 million shares per day. That is a level of volume that signals significant institutional repositioning. Some big players are clearly exiting, while others are either building new positions or averaging down. Alongside the institutions are countless retail traders who are treating Plug like a speculation playground. If you examine the intraday price action, the pattern has been one of choppy, low-range consolidation. This is the classic behavior of a stock that is digesting a major financial event. It trades like a company that has just undergone emergency financial treatment. Nothing stable, nothing predictable, just a stock trying to find its footing after a shock to the system. And this is a dramatic contrast to the long-term narrative of Plug Power as a future leader in what could become a trillion-dollar clean energy industry. Institutional investors play an extremely important role here. Some funds have been selling aggressively, driven by concerns about dilution and doubts about management's ability to control expenses. But at the same time, other large funds have stepped in to buy the dip. Their thesis is that the new financing removes the immediate risk of insolvency and gives management some breathing room. With liquidity no longer being an emergency, Plug can theoretically redirect focus toward execution. And one of the biggest strategic shifts in that execution plan is the company's newly announced pivot towards supplying stationary power for AI data centers. This new angle is extremely important. After the Department of Energy canceled a loan guarantee for several of Plug's plant projects, the company needed to rethink its positioning. AI data centers have exploded in demand due to the massive growth of artificial intelligence. These centers require enormous amounts of reliable power, and right now most of that demand is being met by traditional energy sources. Plug Power sees an opportunity to insert hydrogen into this ecosystem by offering stationary green power solutions to data centers. If the hydrogen market becomes integrated with AI infrastructure, Plug Power could tap into one of the hottest, fastest-growing technology themes in the world. This pivot doesn't guarantee success, but it does offer the company a clear path toward a market that is rapidly expanding and has the ability to support premium pricing. The key question is whether Plug can scale production, improve margins, and fund expansion long enough to truly capture that opportunity. However, no conversation about Plug Power is complete without discussing short sellers. Short selling pressure has been a defining force around Plug Power for many years. Retail investors often hope for a massive short squeeze, believing that the hydrogen market's eventual growth will force short sellers to cover their positions at higher prices. But so far, short sellers have been very effective in identifying and betting against the company's weaknesses. They have correctly predicted ongoing cash burn, numerous capital raises, and a pattern of losses. Short interest in Plug remains extraordinarily high, sitting at roughly 310 million shares. That represents more than 23% of the stock's free float. The days to cover ratio is near 3.0, which is elevated enough to create risk for short sellers if the stock suddenly rises. But the catch is that borrow rates remain low, under 1%, which makes it extremely cheap to stay short. This reduces the likelihood of a sudden organic short squeeze. Investors now need to closely watch next month's institutional filings to understand how hedge funds and major institutions adjusted their short positions after the convertible notes were priced. It will also be important to monitor option markets, especially out-of-the-money call options expiring in mid-2026. If open interest surges in those contracts, it could signal that some market participants expect a meaningful future catalyst or even a potential squeeze. This brings us to perhaps the most important factor of all: government policy. The big unanswered question is whether the government will pass new legislation supporting the hydrogen industry soon enough to materially reduce Plug Power's capital requirements. If meaningful federal incentives or funding programs are introduced, they could dramatically lower Plug's financial risk and accelerate the adoption of hydrogen technologies. But if political action is delayed, Plug Power may find itself needing additional capital raises down the line. So the question now is simple. Do you believe the government will take action soon enough to support the hydrogen sector? Or will Plug Power need to raise even more money before that happens? Share your thoughts in the comments, especially your view on the political timing of any potential hydrogen-related legislation. This video is created for informational and entertainment purposes only. Please understand that I am not a financial advisor.